Hello, everyone. Welcome to a Wall Street for Main Street podcast special. My name is Mo Dawood, and today's special guest is Peter Grandich. Uh, Peter is the founder of Grandich.com and Grandich Publication and is the editor of the Grandich Letter. He would go to hold on position on Wall Street as a market strategist, portfolio manager for four hedge funds, and had a mutual fund that bears his name. His autobiography is called The Confession of the Wall Street Whiz Kid. Peter, thank you for joining us again.
Thank you for having me.
Well, I want to start off talking about your background for a little bit. And you're able to predict many stock market crashes during your lifetime. And I just want to know, how were you able to predict it, and how come many other experts didn't see it coming, like the 1987 crash that we had?
Well, first of all, I appreciate the compliment, but like everyone else, I put my pant legs on one leg at a time. There has been what I've come to conclude after having a very up and down life, that there was a great maker in charge of this, not me, that for some reason allowed me to have some foresight that, like you said, maybe some others didn't. It's amazing when people talk about my 1987 stock market crash, because when I think about it, I was only in the business less than 3 years then, and what I know now after 30 years versus 3 years, it certainly wasn't me that made that forecast. For whatever reason, something else inspired me to do it, because I just didn't have the depth of knowledge then that I do now. And just having knowledge doesn't also guarantee you're able to forecast things. But it's been good, but I've also lost more money multiple times than I've ever managed to think I would have as a young man. So I think I'm as fallible as the next person, but for whatever reason, at certain times, there's been an ability to say something that ended up being right.
Yeah, and we've all been wrong about prediction regarding, either a stock or the market or the economy, and it's hard to predict a economy that's managed by the Federal Reserve and the government. There's no free market.
It's an interesting point that you make. That first of all, I like to say that those of us who live by the crystal ball learn one thing over time, and that's how to eat broken glass. So, we do make errors, but you make a very good point, and I like to expand on that, if I may. I remember when I entered the brokerage business in 1984, there is no rhyme or reason or shape similar now to the markets than were back then. And that's why I also poo-poo when people start to use technical or fundamental analysis from 30 or 40 years ago. I don't think that type of stuff works anymore, because the markets are radically different. They're certainly far more volatile, far more bigger players, and far more things influencing it than it did 30 years ago. There's no question that whether you believe certain people sit in a room and make decisions to buy or sell stuff to help or support markets, I don't think there's any way you can say some side of the support doesn't happen at times, because there's already been so many cases over so many years in different markets that have shown manipulation, and people have pleaded guilty to it. So to think that it doesn't happen is wrong. Where I think the big problem now is for the retail investor. When I entered the brokerage business back in 1984, almost 85% of the daily trading on the New York Stock Exchange back then was individuals, and 15% was institutional. Now it's not only reversed, but probably more 95%. So the people who are playing in the market, I think when you look at it as from a retail person, you have a pea shooter and they have nuclear weapons. So it's become very tough, and I actually believe personally impossible for individuals to beat the market from a trading standpoint. There's just too many things happening now, too many people with foresight and advantages that you can't come to the same game with, and therefore trying to be a trader in markets, I think, is suicidal.
That's an interesting point you just made there, and I believe the era of buying and holding forever is gone, mainly because high frequency trading that's been going on in the market nowadays, and a lot of the retail investors, especially the people on Main Street, they can't keep up with all that. I mean, they have a lot of stuff going on around their lives. They can't keep up with what's going on in the stock market or what's going on in the economy. So when they buy and forget, they're getting killed. And unless the traders are paying attention to the market 24/7, so they have an advantage now. Unlike 30 years ago, where you can buy and hold and it worked for the most part.
The other disadvantage now is something that you brought up, and that is the people who are trading it are not trading it on fundamentals because they think earnings are going to be better or they got new products that are going to make money. They many times don't even know what the company does, but they're using certain trading system and algorithms and all these things that didn't exist 20 or 30 years ago. And you're in there thinking that, well, I'm going to buy this stock because I think it's going to go up because they're going to have better growth in their products. And that's just the other thing that's changed radically over the 30 years that I've watched the markets.
And there's another question I wanted to ask you regarding your background. A lot of experts out there, they're seeing the same data, stock charts, and they're looking at the same economy as you are. How come there's experts out there that come up with a different conclusion on what's going to happen on the economy compared to your own conclusion? Does it have to do a lot with their education and their philosophy regarding the economy, or a lot of it is just a gut feeling or emotion?
Well, I come from a very unusual path. What you will find in Wall Street throughout the years, not only when I started, even now, that most of the people enter from a highly educated standpoint, which means they not only were college grads, they might have had masters in business. I didn't even finish high school. I literally learned by the seat of my pants. That had pluses and negatives. The negatives always was there were certain people that felt without the education there was no possibility that I could be any good than the one that had education. So I was cut off before I had a chance. Where I did benefit from it was people who kind of worked for a living, kind of liked the fact that I was a blue collar guy in a white collar industry. In terms of forecasting, think about this. I always wonder sometimes that if I was just the general public, I was not in this as I have been for 30 years, would I want to deal with a professional group that 75% can't beat the thing that they're measured against? Most people should know by now that 75% of money managers cannot beat the indexes that they're compared to, that people would have been simply better off putting their money in an index fund than giving it to individual money managers. I just can't imagine that if we were facing medical or legal matters, we would go and want to try to pick only the 25% that would know how to figure out what's wrong with me, or the 25% that could win the case. So, again, it goes to and I didn't know we were going to discuss this, but I'm so happy you've given me the chance to air this. It goes to one of the many pet peeves that I have, and that is that the average person out there really is up against it. They really have a very slim chance of being successful in the markets. And then, if I may, my biggest pet peeve, and readers of mine known this for a while, I don't believe what is commonly known as traditional financial planning, or how typically people sit with financial people today make a plan, can work. It's a flawed process. And because of that, most people's goals are never reached. But that doesn't stop the people that are supposedly there to help them from profiting from it. So I just, you went this route. I'm glad, and I had an opportunity to open my mouth about this, and that is that it's really, in the last 30 years, I think it's become extremely tough for individual investors out there to make money in the markets.
And I agree with that, and it's mainly due to the changing dynamic of the economy. We now have a global economy with more intervention by the governments, and so the economy is more central planning nowadays compared to 30 years ago. We had a little bit more free market. And now when you touch the subject of financial planning, the only way for people to retire is to have out-of-box thinking and ideas on ways to generate income for their investment. The old days are done. I mean, mutual funds doesn't guarantee you doesn't guarantee you to become a millionaire, and you can't plan for someone's financial future using a software on a computer either. So that doesn't work.
Yeah, well, there's a big negative, and I know you don't want to have a financial planning discussion. I'll just say this tonight anyway, that even in the U.S., there's a big commercial. People will see a certain firm, people be carrying around their so-called number, and it's the number that they need to have a happily, retirement life. People chase net worth. People judge their success on net worth. The problem is people take undue risk in order to try to reach that net worth. Any successful business person will tell you net worth takes second place to cash flow. Show me a business that failed. It wasn't because people didn't have a net worth to run the business. It's because they didn't manage cash flow right. Cash flow is very, very important. It's an overlooked item in financial planning process that only 15 years ago someone showed and demonstrated to me and changed the way that I approached financial planning, because before that I was like everybody else, trying to turn $1 into 3 to 4 and taking undue risk for that. And I think that's the big misnomer and what leads a lot of people down the wrong path. And it doesn't impact the people that advise that, because if the worst case scenario is that the risk does lead to bigger losses, they still profited from what they did. So this whole thing of where individuals have to step into the waters now, to me, it's just shark infested.
And I completely agree with you. And I want to shift gears here and talk about what's going on in the general market today. There's a lot of people out there that's calling for the market to correct, because if you look at the chart, it's completely overbought. And a lot of people think that the so-called government cuts will impact the market. Do you believe the market will correct soon?
Well, my position has been since the March 2009 that it wouldn't pay to be a bear. Now, I want to underscore the fact that I was not a roaring bull. I didn't suggest load up on, get margined up on stocks and enjoy the rally we had. But for quite some time now, well over a year, possibly closer to 2, I have talked to my readers about the Dow going back and making a marginal new high, and it's risen, several thousand points, and as we speak, is very close to a marginal new high. I did that for a couple reasons, 2 critical reasons. The first is I have operated, and probably readers and listeners of mine are ad nauseum of me saying this, but I operate under the belief that Wall Street is controlled by a group that I've coined the don't worry, be happy crowd. The cup is half full. You can toss them off the top of any large building and all the way down, they'd say the same thing. So far, so good. So there's always an over bullishness to people that work in the industry. They always see the cup half full, and that tends to make markets stay up more than they deservingly so. The second thing is this: like it or not, and you touched on it earlier, the Fed has literally not only mortgaged our future, but they've sustained the markets and have allowed them to rise by all this money creation. Now, Bernanke's argument in his mind, in my opinion, has been, if I propel the financial markets higher enough and long enough, there'll be a wealth effect, and then those people will take that wealth and buy a refrigerator and buy a home and buy a car, and that's how well the economy would do. That's not a bad thought when we were a creditor nation. But to do that in an environment when we're the world's largest debtor nation, and the amount of debt levels we've added to get to that, to what he's doing, will negate all the results that he would normally see. But right now, because so much of that money has been fed into the financial system, it has found its home mostly on Wall Street and not Main Street. That's why the economy barely gets by, but the markets are close to new all-time highs. So my argument would be is we need to get to those new highs. We need a new excitement to grip. We'll hear all these things about a new great bull market. They're already starting to come out with Dow 20,000 and Dow 25,000 and all that, and that will accelerate when we do make the new highs. And then, unfortunately for them, the market will eventually return to what it really is, and that's a place where part ownership of businesses are bought and sold each day, and businesses can only do well over a long period of time if the economy is, and the economy isn't, despite all this money creation, and it will actually get worse before it gets better. So my long-winded answer to you is, I've been a believer of the rally. I do believe we'll get a marginal new high. I do believe we'll have to start to hear a lot of crazy predictions again. But in that environment, we are closer to the end, not the new beginning of a new bull market.
I couldn't say it any better than what you said. And the crowd you were referring to that, don't worry, be happy, is mostly the people that are the board of the Federal Reserve that can get unlimited amount of cheap dollars for basically almost 0% interest and have the taxpayers pay for it so they can continue to speculate on derivatives and gamble.
It's an interesting thing. I've had to this week and again next week give a general economic market speech to what I would call the average Joes. These are just general, hardworking people, members of chambers of commerce, things of that nature. They're not very, very sophisticated, don't understand how money is created and so forth and so on. And when you get to talk to them individually, you realize that they have no idea, but when explained to them and to show them that how money is actually created, how the United States goes into debt, and then what they created, that instrument, is created as an asset when there's really nothing backing it, they start to understand the ramifications, and they ask the same question all the time. What happens if things turn? What happens if interest rates go up? What happens if we get to the point where we just can't pay? And people are understanding that because we can't create unlimited money. They put you in jail if you do that. But that's where the Federal Reserve has been. It's been as much sometimes as 75% of the purchasing of government securities in the last 2 years. And so when this talk comes out, and every seemingly few weeks it comes out, that quantitative easing may end, I ask the question, as a good friend of mine and a top money manager, Michael Pentel, does, and says, how can it? Because if you just take the Federal Reserve and remove the purchases that they've been making these last 2 years, who replaces them to buy all this debt that we need to continue running our government? And at what interest rate are those people going to want to keep purchasing? That's why not only is the talk of quantitative easing ending, but it can't have a happy ending. So it's just like drinking more of the punch and staying drunk longer, but eventually the hangover is going to come, and the longer you don't face it, the worse it's going to be. And that's really what we face. I don't know the date. I really don't. I wouldn't want to risk my life on guessing it, but it's coming. And I don't think it's going to be too long. It's not going to be 5 or 10 years before we pay that piper. It could be as early as this year, and in the worst case scenario, a couple more years. But we're very close. We're like that when you look at those pipes that have that red zone, and if the temperature gets too high, you're in that danger zone. We're in the red zone, and any mechanic will tell you once you're in there, it can blow at any time. And that's where we stand right now, particularly when it comes to the stock and bond market.
And also, if you look at the balance sheet of the Federal Reserve, which recently went over $3 trillion, there is no way that the Federal Reserve will stop the QE and start to pull back. The investors out there is going to want to demand double-digit interest rate on the new bond that they're going to put out in the future. And I wanted to ask you about the Federal Reserve. They recently put out a report that they're considering cutting the QE and pulling back, and then you have Bernanke go in front of Congress and say QE will continue on until the labor market improves. Do you think they're trying to control the inflation expectation by manipulating the headline in the news?
Well, my opinion is there's definitely some dissension in the Federal Reserve now. I think some of the Board of Governors have concluded that QE to infinity has a bad ending. But there's no answer that better than keeping it going until further notice. And the problem is then it only multiplies, because you could almost say that they could almost accept that problem if there was some fiscal responsibility out of Washington, that there was really movement to correct the terrible problem we have in entitlements, that government spending's gone too much and we need to cut spending and actually raise revenue. If they saw that at least happening, they could almost, in a sense, I think, feel that they can get by for now with QE to Affinity. The problem is they don't see that, and they're not dumb people. I think the mistake some of us make is that these people have no idea what they're doing. I actually believe they know exactly what they're doing, and they also know the perils of what they're doing, and they're hoping beyond hope now that can somehow change, and they're not getting any help on any sides. And for me, I kind of watch Bernanke's face, and the most tense part, or what I would view as disenchanting face, is when he had to speak about how Washington was not doing what was necessary to put, as Eve said, America back on the right track. So I just think, like I said, we have a period. The fuse is getting shorter and shorter. I don't know exactly when, but we're very close in terms of time left compared to how much time we've already had doing this, to where, as I like to say, the chickens come home to roost.
And one final topic I want to discuss with you before I let you go is the gold and silver market, which has been frustrating for a lot of investors who wouldn't for the consolidation to end and for them to make their next move up to the new all-time high. And and that's been happening for a couple of years, and it hurt a lot of the gold and silver stocks as well, especially the juniors. And I don't know if you read John Kaiser's
yes, I did.
interview.
I know the report you're referring to, yes.
Yes, on the gold report, and he said that unless we have a big move in gold and silver, there's over 500 junior mining companies, gold and silver, on the TSX that could go bust or will have to sell their assets for pennies on the dollar in the next 6 months. Do you agree with that?
Well, first let me say that I have lost myself over 50% in the last 18 months, primarily in the junior resource market. I have never imagined in the 30 years I've been in this business that somebody would tell me that gold would be at $1,600 and silver would be at $30, and junior resource stocks, many of them with proven assets, are selling for 1/10 of their net asset values. It makes no rhyme or reason if you were in this 20 or 30 years ago. It's not an excuse for being wrong. And while sometimes I think I'm one of the few people that actually use the word wrong in the junior resource business, nevertheless, it's been a very hurtful experience. And part of the problem has been that even though, if you look at it from an 18-month standpoint, okay, gold's about where it was 18 months ago. Being even over 18 months isn't the worst thing in the world. But at the same time, if you had mining shares, and the further down you went the food chain into the more riskier exploration, the larger the percentage losses have been universal. It just doesn't make any sense. And what's really transpired now is it's not frustration anymore or disappointment. It's actually giving up. People are now just indiscriminately selling whatever they can get because the pain has become too much to take. And John Kaiser was right. There are a host of companies that realistically, if it wasn't for the listing dollars, this is my opinion now, not what John might or not said, but if not for the loss of listing dollars, primarily on the Toronto Stock Exchange, 80% of them should be just delisted. They just, they're not really true operational companies. They have nil for capital. They have really no activity if they do still have any real projects of merit. And they would very much help out the overall market if they would disappear. And they may eventually have to. But right now, there's just no way the junior market can rebound and stay up without a significant move of gold back to the upside. And of course, the fear is, and this is the nightmare for everybody, and let everybody know I have this same thought. The fear is, well, what if it does break down? If you think they're already low, what if gold falls a couple $100? Where are these shares going to? And that's just the utter ripping of one's stomach that if you have exposure, as I have, to juniors, that you're going through. The only thing that I can say of comfort, and not trying to fool my own self, is we've been at this before. We've been at where juniors have been driven to extremely depressed levels. We saw it in 2008. We saw it at the change in the millennium. And, they ended up having major, major rebounds after that. But I don't see that happening until there's a combination of the removal of a lot of these deadwood juniors and a significant rebound in the metals prices.
And do you believe this is a reflection of bad management by the junior mining companies, or this just the mining industry is very complex. It's very hard to implement a mine into production, on time without delay. Which, if you listen to Nolan Watson's video interview he did on his own website, the CEO of Sandstorm Gold, he said that over 80% of companies don't actually go in production on time, which tells you, how difficult and complex it is to succeed and to deliver on market expectation.
Well, first, let's remember one thing. When we talk about juniors, we're dealing with a business where failure is the norm. So 8 or 9 out of 10 are not going to succeed no matter what the conditions are. Now, I have spoken, it's there on my blog for almost 2 years, that it's much harder now to be in the junior resource business than it was 10 or 20 years ago, despite metal prices substantially higher. There are a lot of reasons, and I'll run through them real quickly. First and foremost, we just don't have the type of players that we used to have 10 or 20 years ago. 10 or 20 years ago, there were hundreds and hundreds of brokers in North America who did retail business, mostly buying and selling stocks, and many of them came, for lack of a better description, gold brokers. They don't exist anymore. The commission-driven business in the brokerage industry is a dinosaur. Every year it becomes less and less. The financial service industries become asset gatherers, so those people that used to buy and sell these juniors just don't participate in that business anymore. Second, the industry itself has much tougher times. I like to tell people 20 years ago, I could put my head on the pillow tonight and think of only 1 or 2 or 3 places in the world that if I had a junior company operating, maybe I sleep with one eye open because there could be some sort of political or environmental or some type of problem. Now there's only a handful where you can go to sleep without sleeping with one eye open. The other difficulty that's come out is over-regulatory. People don't realize, but as good as 43-101 rule was and regulatory grabbing, juniors are nothing more than hopes and dreams. That's really what they're going on. And you used to be able to tell a good story about your hope and dream. Now you can basically say nothing, or almost nothing. The other thing that transpired, and people don't realize this is very critical, is the private placement industry, which really juniors live off of. They're burning matches. They have to constantly raise money. Well, you used to have to hold those stock 2 years and then a year. Now it's only 4 months. Too much paper comes back into the market too fast before companies have a chance to move forward. And lastly, and this is my real knock against companies, and remember, part of my livelihood and my life is working as consultant to junior companies, but the problem is many of these guys run it as a private company. They become entrenched in it. It's their only real source of income, and they will do everything and anything to keep the lights on so they can pull a paycheck. And they make many erroneous decisions because of that. And it's very difficult to bring change in companies like that. And therefore, there's just a combination of a whole sorts of things that I haven't even mentioned, plus the simple fact that, despite the increases in metals, the cost of bringing out metals from the ground has matched or exceeded those increases. So it's literally far more difficult despite 300 to 500% increases in metal prices over the last decade or so.
Yeah, and I think the biggest challenge miners will have in the next few years is the rising input costs. So, therefore, the cutoff grade for gold and silver will continue to go up and up, and the capital expenditure for bringing a mine online will continue to go up as well. And that's going to be a big problem for a lot of these miners out there. So you'll see a lot of mines will become uneconomical to bring online. So the supply in gold and silver might become tighter.
Yes, that is over the long run, but there's nothing on the immediate horizon that I could give to people and say, listen, we can see a 50 or 100% rise here before summer. It's just there's nothing in the market now that can do that, because if we get a pop, the first real pop is going to be used for people to remove the anguish that they now feel. So it's tough sledding until further notice for the junior resource market.
Well, Peter Grandich, I appreciate your time coming on Wall Street for Main Street podcast. If people want to find out more about what you do, where can they go?
Just feel free to go to Grandich.com, and everything is self-explanatory there.
All right. Well, thank you for coming on, and hopefully you can come on in the future.
Be glad to.